In finance, reconciling your bank statement is essential. Compare your bank statement with your cash book to ensure they align. Identify and explain discrepancies. Match receipts with statements to account for spending. A bank reconciliation statement summarizes this process. It lists starting and ending balances, details transactions and adjustments, gain a clear financial picture, identify errors and unauthorized transactions. Essential for financial health. Bank reconciliation is crucial for both businesses and individuals. For businesses, it ensures that all income and expenses are accurately recorded. This accuracy is fundamental for making informed financial decisions, securing loans, and accurately reporting taxes. Without regular bank reconciliations, businesses risk overlooking errors that could lead to financial losses and misinformed business strategies. For individuals, bank reconciliation provides a clear understanding of their spending habits. It allows them to track their income and expenses effectively, ensuring they're staying within budget and meeting their financial goals. Regular reconciliation can also help individuals detect any unauthorized transactions or identity theft, safeguarding their hard-earned money. In essence, bank reconciliation is a proactive measure that empowers individuals and businesses to maintain financial control. It promotes transparency, accuracy, and peace of mind, knowing that your financial records are in order. Whether you're a seasoned entrepreneur or just starting to manage your finances, understanding and implementing bank reconciliation is a critical step toward financial well-being. Before embarking on the journey of bank reconciliation, it's essential to gather the necessary tools. These tools are your financial compasses, guiding you through the process. The first tool is your bank statement, a detailed record provided by your bank, outlining all transactions that occurred in your account during a specific period. This statement is typically issued monthly or quarterly, depending on your bank and account settings. The second crucial tool is your cash book. This record, maintained by you, mirrors your bank account but from your perspective. It diligently logs every deposit you make and every check you write. Think of it as your personal financial journal, meticulously tracking the ebb and flow of money in your account. These two documents, though seemingly independent, are intricately connected. They represent two sides of the same coin, each providing a unique perspective on your financial activities. The bank statement reflects the bank's view of your account, while the cash book embodies your understanding of your financial transactions. Your bank statement is more than just a list of numbers. It's a detailed record of your financial transactions. Each transaction includes a date, description, and amount. Interest earned and fees charged are also listed. Understanding these details helps you manage your finances. Section 3. Demystifying the cash book. While your bank statement provides the bank's perspective, your cash book offers your unique insight into your finances. It's a mirror image of your bank account, meticulously maintained by you or your designated bookkeeper. The cash book diligently records every financial transaction, ensuring that no deposit or withdrawal goes unnoticed. Each entry in your cash book should be detailed and accurate, including the date of the transaction, a brief description, and the exact amount. This meticulous record-keeping forms the bedrock of accurate bank reconciliation. Remember, your cash book is your personal accounting ledger, reflecting your understanding of your financial activities. Maintaining an up-to-date and accurate cash book is paramount. It serves as your primary reference point during the reconciliation process. By diligently recording every transaction, you create a transparent and reliable record of your financial dealings, empowering you to reconcile your account with confidence. Section 4. A solid foundation. The importance of accurate starting balances. As you embark on the journey of bank reconciliation, the first and most crucial step is to establish a solid foundation. This foundation lies in ensuring that the opening balances of both your bank statement and cash book are in perfect harmony. The opening balance represents the amount of money in your account at the beginning of the reconciliation period. Begin by carefully comparing the opening balance on your bank statement with the opening balance recorded in your cash book. These figures should match precisely, reflecting a shared understanding of your starting point. Any discrepancy in these initial figures will cascade through the entire reconciliation process, leading to inaccurate results and potential confusion. If the opening balances do not align, it's crucial to investigate and rectify the discrepancy before proceeding. This may involve reviewing past transactions, verifying entries, or contacting your bank for clarification. Remember, a solid foundation built on accurate opening balances is essential for a successful and meaningful bank reconciliation. Section 1. Diving into the details, comparing transactions. With your opening balances aligned, the next step in the bank reconciliation journey is to delve into the details. This involves meticulously comparing each transaction recorded in your bank statement with its corresponding entry in your cash book. This process, though seemingly meticulous, is crucial for identifying any discrepancies that may exist between the two records. Begin by carefully reviewing each transaction listed on your bank statement. Check the date, description, and amount of each transaction, ensuring that it matches precisely with the corresponding entry in your cash book. Use a check mark or highlighter to mark off matching transactions in both documents, providing a visual cue of your progress. As you meticulously compare each transaction, pay close attention to any discrepancies that may arise. Discrepancies can include missing transactions, differing amounts, or incorrect dates. These inconsistencies, though seemingly minor, can signal potential errors or omissions that need to be addressed. Section 2. Unveiling the unmatched identifying discrepancies. Compare your bank statement and cash book to find unmatched transactions. These discrepancies are crucial clues in reconciliation. Unmatched transactions can arise for various reasons. Outstanding checks and deposits in transit are common. Bank charges or interest earned may also cause discrepancies. Identifying each discrepancy is key to reconciliation. Section 3. Timing is key. Understanding outstanding checks. Outstanding checks occur when written checks haven't been cashed or deposited, causing discrepancies in records. Compare your cash book with the bank statement to identify outstanding checks. List these checks separately with their numbers, dates, and amounts. Section 4. Deposits in transit. Bridging the gap. Deposits in transit can create discrepancies just like outstanding checks. These deposits often don't clear in time to appear on your current statement. This timing lag can lead to differences between your cash book and bank statement balances. Imagine making a large deposit on the last day of the month. The bank processes it the next month, causing a temporary discrepancy. Review your cash book for deposits not reflected on your bank statement. List these deposits separately, noting their dates and amounts. These deposits should be accounted for during reconciliation. Section 5. Reconciling with confidence. Adjusting your cash book. Adjust your cash book for outstanding checks and deposits in transit. Subtract outstanding checks and add deposits in transit. These adjustments align your cash book with your bank statement. Section 1. Unraveling bank errors, a common culprit. While we strive for accuracy, even banks with their sophisticated systems can occasionally make errors. These errors, though unintentional, can create discrepancies in your bank reconciliation. Identifying and rectifying these errors promptly is crucial for maintaining accurate financial records. Bank errors can manifest in various forms. A common error is a transposition error, where the bank accidentally reverses digits when recording a transaction. For instance, a deposit of $542 might be mistakenly recorded as $452. Other errors can include posting a transaction to the wrong account, either yours or another customer's, or incorrectly recording the amount of a check or deposit. While bank errors are less frequent than other reconciliation discrepancies, they underscore the importance of meticulous review. When comparing your bank statement and cash book, pay close attention to transaction details. If something seems amiss, don't hesitate to contact your bank and request clarification. Section 2. Unveiling hidden fees, charges to watch for. Banks provide a valuable service, safeguarding our money and facilitating transactions. However, these services often come with associated fees, some of which can be easily overlooked. These hidden fees, if not accounted for, can create discrepancies during bank reconciliation. Common bank fees include monthly account maintenance fees, overdraft charges, ATM withdrawal fees, and foreign transaction fees. These fees, typically deducted directly from your account, may not always be reflected in your cash book until you receive your bank statement. To avoid surprises during reconciliation, familiarize yourself with your bank's fee schedule. Review your bank statement carefully for any unfamiliar deductions, and ensure these fees are accurately recorded in your cash book. This proactive approach helps maintain transparency and avoid unexpected discrepancies. Section 3. Interest earned, a welcome addition. While bank fees can decrease your account balance, interest earned provides a welcome addition. Interest, a reward for keeping your money in a savings account or interest-bearing checking account, represents a credit to your account. The amount of interest earned is typically calculated based on your account balance and the interest rate offered by the bank. This interest is usually credited to your account on a monthly or quarterly basis depending on the bank's policy. During bank reconciliation, ensure that any interest earned as reflected on your bank statement is accurately recorded in your cash book. This ensures that your cash book reflects the most up-to-date balance, including any interest accruals. Section 4. The art of correction, adjusting for discrepancies. Once you've identified all discrepancies between your bank statement and cash book, the next step is to make the necessary adjustments. This involves correcting any errors or omissions in your cash book to ensure it aligns with the bank's records. For bank errors such as transposition errors or incorrect postings, contact your bank immediately to report the error and request a correction. Once the bank acknowledges the error and provides confirmation of the corrected transaction, adjust your cash book accordingly. For outstanding checks, no adjustment is needed in your cash book. These checks, though deducted from your cash book, haven't yet cleared the bank, so they remain as outstanding items until processed. Similarly, for deposits in transit, no adjustment is required in your cash book, as these deposits are reflected in your cash book, but haven't yet appeared on your bank statement. Section 5. The Balancing Act, Achieving Reconciliation. The final step in the bank reconciliation process is to compare the adjusted cash book balance with the ending balance on your bank statement. If all discrepancies have been identified and adjusted for accurately, these two balances should match perfectly. This harmonious balance signifies that your records are in sync with the bank's, providing assurance that your financial picture is clear and accurate. If, however, the adjusted cash book balance still differs from the bank statement balance, it indicates an unresolved discrepancy. This discrepancy could be due to an unidentified error, an omission, or a transaction not yet accounted for. In such cases, carefully review your work. retracing your steps to ensure accuracy. Double-check all transactions, adjustments, and calculations. If the discrepancy persists, seek assistance from your accountant or a financial professional to help identify and resolve the issue. Unraveling the mysteries common bank reconciliation issues. Bank reconciliation, while a fundamental financial practice, can sometimes feel like solving a mystery. Discrepancies arise, leaving you puzzled and searching for answers. Fear not, for even the most perplexing reconciliation issues often stem from common errors that can be easily identified and rectified. One common culprit is the elusive transposition error, a simple yet frustrating mistake that can occur when manually recording numbers. Imagine accidentally swapping digits when entering a check amount in your cash book, turning $345 into $435. This seemingly minor slip can create a ripple effect, leading to a head-scratching discrepancy during reconciliation. Another common issue is the case of the missing transaction, where a payment or deposit seems to have vanished into thin air. This could be due to a forgotten entry in your cash book, a delay in processing by the bank, or even a simple oversight during the reconciliation process. Transposition errors. When numbers play tricks. Transposition errors occur when digits are reversed, creating discrepancies in your bank reconciliation. These errors can be identified if the difference is divisible by 9. Missing transactions. The case of the vanishing payment. The case of the missing transaction can be particularly frustrating, as it involves a payment or deposit that seems to have disappeared without a trace. This discrepancy can arise from various scenarios, each requiring a different approach to resolution. One possibility is a forgotten entry in your cash book. Perhaps you made a cash payment but forgot to record it, or a check you wrote was cashed but never made its way into your records. In these cases, the bank statement serves as a valuable reminder, prompting you to retrace your steps and uncover the missing transaction. Another possibility is a delay in processing by the bank. Deposits made near the end of a statement period, particularly on weekends or holidays, may not clear in time to appear on your current statement. Similarly, checks deposited but not yet cleared can create a temporary discrepancy. Section 4. Duplicate entries, double trouble in your books. Duplicate entries, the bane of accurate record keeping, occur when a transaction is mistakenly recorded twice, inflating or deflating your account balance artificially. This error, often a consequence of hasty data entry or confusion during reconciliation, can lead to significant discrepancies and distort your financial picture. Imagine accidentally entering a deposit twice in your cash book, effectively crediting your account with double the actual amount. This error creates a false sense of surplus, potentially leading to overspending or inaccurate financial decisions. Detecting duplicate entries requires meticulous attention to detail. When comparing transactions, look for entries that are identical in date, description, and amount. If you find a match, verify that the transaction appears only once on your bank statement. If confirmed as a duplicate, remove one of the entries from your cash book to rectify the discrepancy. The importance of timely bank reconciliation cannot be overstated. Regular reconciliation, ideally monthly or even more frequently for businesses with high transaction volumes, is crucial for maintaining accurate financial records and detecting errors early on. Timely reconciliation allows you to identify and address discrepancies promptly, preventing them from snowballing into larger issues. It also enables you to track your cash flow effectively, ensuring you have a clear understanding of your income and expenses. Moreover, regular bank reconciliation acts as a safeguard against fraud. By diligently reviewing your account activity, you're more likely to spot unauthorized transactions, forged checks, or other suspicious activities, This proactive approach can help protect your finances and provide peace of mind. Section 1. Bank reconciliation, your financial safety net. Bank reconciliation ensures every step is in sync, transforming chaos into clarity and providing control over your finances. It identifies and rectifies discrepancies, preventing larger financial headaches. Bank reconciliation also helps detect fraud, safeguarding your money and providing peace of mind. Section 2. Embrace reconciliation, a path to financial clarity. In today's fast-paced world, it's easy to feel overwhelmed by the constant flow of income and expenses. Bank reconciliation offers a clear snapshot of your financial position. Embrace regular reconciliation to take control of your finances. This proactive approach empowers informed financial decisions. The benefits extend far beyond accuracy. Gain a deeper understanding of your spending habits. Pursue your financial goals with confidence and clarity. Bank reconciliation is an investment in your financial well-being. Embrace it for financial clarity, accuracy, and peace of mind.